Welcome to the Weekly Juice Podcast, where we discuss all things real estate, personal finance, investing, entrepreneurship, and the many ways to achieve financial independence. We interview accomplished investors and entrepreneurs with the goal that their stories inspire you to take control of your financial future. Here to get your creative juices flowing, while also documenting their own personal investing journeys, are your hosts, Corey Jacobson and Ryan Bevilacqua.
Hey, welcome back to the Weekly Juice. It's Corey here today. We had a fun episode, man. Ryan's not here, but we still had a fun episode. I interviewed Rob Beardsley. He runs Lonar Capital, Texas-based multifamily acquisitions company, offering multifamily opportunities to investors looking to passively grow. And Lone Star is Texas, right? Rob's got a cool story. He's only 27, and I found this out like halfway through the episode. I didn't realize he was so young. He's all buttoned up. He's got a suit on. New York guy. Lives in New York. His company's based in Texas. From Silicon Valley originally. Went to Carnegie Mellon grade school to play football, but ended up dropping out because of the real estate. He partnered with somebody who's I think in his 40s now, a little bit older than him, but like they had this perfect blend partnership, according to Rob, where they're able to buy multifamily together. And in Texas, Rob takes us through like, this is like a why multifamily kind of episode. Like why from a limited partnership standpoint, if you're going to invest passively, from a general partnership standpoint, if you're trying to grow your multifamily portfolio. But Rob didn't go into single family at all. He never even bought one. His parents were in real estate, but they only did single family and small residential. But Rob went right into multifamily. His first property was a large acquisition. And then from there, he was able to scale. He loves New York. And we talked about like money and lifestyle and a lot of the cool aspects of what real estate can provide for you, but also the why behind it. What's he doing it all for? I thought it was really cool. A little bit of a shorter episode today. We get right to it. But as always, we're having some fun. So without further ado, let's bring in Rob Beardsley.
Having purchased investment properties as well as primary residences, we know how daunting it can be to find a reliable lender to secure financing for real estate in the market today. With the up and down of the market, high interest rates, and the complexity of the process, honestly, it can feel like a lot. So to help out our community, we decided to bring on probably the most important person or one of the most important members of our personal real estate investing team onto the show to help out our listeners. Our mortgage lender, Travis David of CMG Home Loans, has agreed to educate our community and assist anyone looking for real estate financing. Whether you're a real estate investor looking to fund your next project or simply looking to purchase a primary residence, Travis will be able to help you and point you in the right direction. So he provides each of his clients with a tailored roadmap designed to guide them through purchasing their first investment property and strategically scale their portfolios over time. So if you're looking to either purchase your first residence or maybe second residence, but a primary residence or invest in real estate, Travis is your guy. Visit our website at www.juice-enterprises.com/need-funding to book a call with Travis to explore all the loan packages that him and his team currently have available. He'll also help assess your current situation and will work with you to map out a plan for the future. So just remember this, we can all win. This is an example we really wanted to help out our community and something we find people are lacking in a daunting process. So if you are looking for real estate financing, we have your back. Make sure to visit our website and Travis will take care of you. Quick public service announcement for all of our listeners. First off, we want to thank you all for tuning into the show, not only this week, but we've seen you coming back episode after episode. And one thing we'd really like your assistance on, if possible, you know that our content's free and it takes a lot to pump this out every week. We're really looking to enhance our overall reviews on the show. That can be on Spotify, but mainly we are looking for Apple Podcasts. If you could please leave us a 5-star review, that will go so long and so far for us. Really, when people are looking to get on shows, they look to see how many 5-star reviews that show has and the number of reviews. So if you haven't left one, please just click on our show. You can scroll down to reviews and then leave the 5-star. Even if you can write a little blurb about us, like what maybe has helped motivate you or anything that is relatable to your life, that would go such a long way for us. And then in turn, it allows us to get high quality guests for future episodes. So if there's been a motivating episode that you can really think back to and that has really helped you in your life, please leave a review because we'll be able to get someone like that on the show in the future to help someone else out. So that would be very much appreciated. And we look forward to continuing more episodes for you.
Rob, officially welcome to the Weekly Juice podcast. I'm excited to interview you today. I appreciate your time. Thanks for coming on the show, man.
Yeah, glad to be here.
Cool. So for people that don't know you, Rob, you're big in multifamily in Texas, hence your company's name, Lonar Capital. I'm curious if, before we get into all the real estate and all the fun stuff people want to hear, tell us a little bit about yourself, who you are, where you're from, maybe your inception story into business and real estate investing in general.
I grew up in Northern California. I actually grew up in a real estate family. So my parents, they ran a residential brokerage firm from home. So I had a lot of exposure to real estate because they worked at home. I was around them all the time. My dad was on the phone talking to clients, talking deals all the time. So I definitely had a lot of that exposure growing up, but I also grew up in Silicon Valley. So I had a tech influence as well. So those are kind of the two big influences growing up as far as business and career. So I ended up going to college for computer science at Carnegie Mellon to kind of pursue that tech side of things and maybe join a startup or work at a large consulting firm or something like that. But in college, I got the real estate bug, was starting to read up on multifamily in particular because my parents only had experience in single family. And then I had discovered the amazing magic of multifamily, and that from there I was hooked and just kept learning and networking and trying to soak up as much as I could. And around that time as well, I met my business partner, and only a few months thereafter we put our first deal together under contract. And after that, it was like, okay, this is serious. Let's go full time into this. And after we closed our first deal together, we kind of formally created a company together rather than just, hey, let's partner on a deal. And I dropped out of school. He left his job. He's much older than me, so he had a long career as a tax attorney. So for him, me dropping out of school, that's nothing, right? That's not a big risk. Him with kids, a family, the whole thing, a whole career, like walking away from that was the big one.
Yeah. That's so you've done your whole trek across the United States, Silicon Valley, Carnegie Mellon's in PA, correct? Pittsburgh area? Yeah. Okay. We're in Philadelphia. So Silicon Valley to Pennsylvania. Now Lone Star obviously is Texas. I'm curious how, you did the triangle of the US there. How did you get from, starting this company to Texas and then basing your roots kind of there?
Yeah. So it's a funny story. I mean, I grew up in California, but then Carnegie Mellon was the best school that recruited me for football. And that was my in. I mean, I love football. Football was my passion. My identity was that I'm a quarterback. And that was a very good season of my life. And it taught me a lot of lessons. But I really knew that I was working hard and leveraging football to get into the best college I could possibly go to. And that ended up being Carnegie Mellon. So that's why I ended up in Pittsburgh. It was a cool change of scenery, seeing snow and different than California. And then it also brought me one step closer to New York City. And I ended up coming out to New York a handful of times. I have some family out here. And when I experienced New York for the first time, I fell in love, and I had no idea what I wanted to do in life, but I knew that I wanted it to be in New York. And so the next summer I came back to New York City for an internship, loved it even more. And then when I met my business partner, he just so happened to live his whole life in New York. So it was such an easy decision for me to move and join him out here. And so that's kind of my New York story. And then Texas is kind of another random wrinkle of the story. But my business partner and I, we both were independently looking at multifamily properties in Texas before teaming up, before getting to know each other. So my original vision and dream was to have my dad be my business partner and have a true family business. So my dad and I, we started looking at some deals together, and we were looking in Texas because it's just a big market, hot market, a lot of opportunity, a lot of investors want to be there. But unfortunately, my dad was just too busy with his brokerage business to really be an honest partner with me. So it was, fortunate I was able to meet my partner Kent, and we have an amazing partnership in Lone Star. and it's all come together really well.
Yeah, man, lot to unpack there. But so New York is such a captivating place, and I can see why you fell in love with it. My sister's the same way. She lives in Brooklyn, and she can't be without New York for like 6 months. She like starts to freak out. I'm not like that. I love visiting, but it's too much for me in one place. But I see why people love it. I'm going a little bit off script here, but I want to talk about college. And the reason why I'm bringing this up is because we just posted something on Instagram about going to college versus not going to college. And you had an interesting dynamic there where you did, and you went for football and then you ended up dropping out. Knowing what you know now, would you tell people, and I'm sure it depends on the person, but I put this post up and I have my opinion about it, but I'm curious to hear yours being successful in business. Would you tell somebody in 2024, 2025 to go to college, seeing that you did it and then dropped, like you had the full experience? I think there's some younger viewers that are listening, or even people who are in their 40s and 50s who are having kids that are going to get to that age soon. So what are your thoughts on that?
Yeah, it's definitely a hot topic. It really depends on the individual. I don't want to tell everyone to drop out and be like me and everyone's going to be successful. I think college has a place, a very valid place in society, and for many people, and arguably for most people, going to school for 4 years is, well, I don't know. I would say it's probably the best place for a lot of people, but then again, it really just all depends, because is it better than sitting around at home doing nothing? Well, yeah, for sure. But if you have to pay 200 grand for it, is it a good idea? Probably not. I mean, that's the reality of it. Once you start actually, if you're looking at like full tuition, obviously there's a lot of ways to get college done for a lot cheaper than that, but it's an investment product. You're looking at investing time and money into something, and it needs to give you an ROI. And I think, unfortunately, a lot of the times that math equation does not add up. So if you're trying to be average, you could probably go to school and go the average path and get an average result. But if you're trying to not be average, then school won't kill you, but it's not necessarily going to get you to where you want to be.
I totally agree with that. And it's very similar to what I posted is I was like, if you know what you want to do, you absolutely know what you want to do, and you want to be a doctor, an attorney, or you want to be something like that, that fortunately or unfortunately, the system is built so that you have to go to school, right? And if you're getting help with paying for college, go, networking, relationships, it's all there for you. If you don't know what you want to do and you're going to go into debt, I mean, as long as you're hungry enough to go search, I would say don't go. So that's our college spiel. But I wanted to ask you, being that you said you dropped out, and it sounds like it was an amazing decision. I want to get into what happened next. Rob, most people, when they get into real estate, myself included, they buy a single family, they buy a duplex, they buy an 8-plex. If they're lucky enough, they get into larger multifamily. I haven't talked to that many people who went right into multifamily. Now, you had your parents did some real estate, but it doesn't sound like in the multifamily space. What was it like buying your first deal that would, I guess some could consider it small. I would consider it large, right? I'm sure you did at the time too, because, there's people that have done this, but not many. So what was it like going direct into multifamily, and how did you feel about that, when you first started?
It was a good decision. I think people that think linearly about it, meaning one unit, single family to duplex to fourplex and on, I mean, that's a waste of time. If your end goal is to be buying a 200 unit deal, you should probably try to buy a 200 unit deal right away. If your goal is to buy fourplexes, then buy a fourplex. All right, and there's nothing wrong with that. You can make a lot of money there as well, but it's not helpful to buy a fourplex, because it's just the additional incremental work from the fourplex to the 200 units is not that much. In some cases, it's actually easier. The hardest part, obviously, and the part that scales linearly, is the amount of equity that you need to raise. So if you're talking about doing bigger deals, you don't have all the money to do it yourself. You need to raise equity. Now, obviously, right? And so if you need to raise $1 million, that's one thing. And if you need to raise $10 million, that's another thing. So that, obviously, you want to be realistic about that. And so for us, that's kind of my only regret, I would say, is that we underestimated how hard it is to raise money. I think everyone generally underestimates that. Everybody thinks, if I have a good business plan, if I have a good idea, I can probably talk to some people and I can raise the money, right? Everyone wants a good deal, but the problem is no, everyone doesn't want a good deal. What people want is they want to invest with someone that they know, like, and trust. And most importantly, they don't want to look stupid. So they're going to be afraid to invest with someone that they don't have a relationship with.
Right. That's well said. And now, Rob, you've acquired over 600 million, just to give people a perspective, in multifamily. So you've done this and done it well. Ryan and I have done some small raises, 506C and B. We've done a couple. We own an 18 unit, general partner on an 18 unit, general partner on a ground up development project. But we're really rookies in the raising capital game. So I want to get into that a little bit. Maybe some, both on the GP and LP side, like both factors. What are some benefits into investing into multifamily that you see from someone who's been doing it longer than me? We dipped our toes a little bit. I think it's something that we're going to get better at as our real estate portfolio grows, and we can prove to people that we can do it on our own, right? But it's a scary thing. There's one thing to lose your own money. There's another thing to lose investor money. And Ryan and I have had this conversation. Like I would put investor money over ours. I'd rather lose my own. And I'm sure you're the same way. So I'm curious, give me some benefits of what you're seeing by doing that, and maybe some downfalls of it as well.
Yeah, there's a lot to be said about this topic. I mean, you're absolutely right. Losing someone else's money is way worse than your own, because you can always make your money back. You can always go make more money. But if you burn a bridge or if you hurt your reputation, that's actually much, much harder to build back. So now, if it's like, okay, hey, would you rather lose, let's say, $1 million of investor money or $10 million of your own money? You're probably going to say,
Sure.
you know what, have my investors lose $1 million, right? So there's some equation there. There's some breaking point. So I wouldn't recommend, as much as it sounds good to like fall on your sword and go out on your shield, there is a breaking point. If a sponsor has such a bad situation on their hands that it would require millions of dollars for them to save like a smaller sum for their investors, it probably makes sense to just, figure out a solution there. So anyway, that's kind of another topic, but that point number one is very true. Reputation is everything. And then the other point is, you said that, I know that you guys aren't rookies in real estate. You guys are experienced in real estate, but you said
Depends
that
who you ask, Rob. Depends who you ask. But yeah.
Well, but you said you're more of a rookie on the capital raising side. And I think that's really important to point out, because they're two completely different skills and two completely different businesses. They don't necessarily mean anything to each other. You could be the best real estate investor in the world. That doesn't make you a good person. That doesn't make you good at raising capital, and vice versa, right? You might see someone who's really good at marketing, really good at sales, but at the end of the day, they're not a good real estate investor. So I think that's hard for people to understand, both on the GP and the LP side, because a GP might think, I'm a great real estate investor. Look at these good returns. Look at my team. Look at how I'm able to find these great deals. Why aren't I raising equity? Why don't investors want to invest in me, right? They're being stubborn because they don't realize that they need to actually commit full-time effort towards this whole new business called raising money. And then on the LP side, it's another thing, because they might see a really good marketing machine and mistake it for a really good real estate investing company. And I'm not saying, oh, well, if someone has fancy marketing and they're a guru, then they're a scammer. That's, absolutely not. You can be good at both, right? Someone can have good marketing and be a good real estate investor, but they don't automatically mean the same thing.
Yep, 100%. And that's, I think, maybe the hardest thing, because social media is so filled with scams, filled with great things, filled with all the above, right? But it's really hard to decipher, right? And so, great answer there. I want to talk about the actual multifamily asset and why you like it. Like, what are the fundamentals about it that make it attractive to you? Because you didn't go into single family. We're talking about the fact that you like it, but I'm curious as to the why. What are the metrics that you're seeing? You don't have to get too specific, but why go into that? Why be a GP or an LP?
Well, on the GP side of things, multifamily is a fabulous business because it is a large institutional asset class. So you can scale your business in a very straightforward way. You don't have to think of some genius plan. You literally just add zeros to your unit count and zeros to your deal sizes and meet bigger investors, meet more investors. It's a very simple business, very simple formula. There's other real estate ventures that are much more complex. Development is much more complex and has more risk. And in my opinion, in many cases, it doesn't actually offer a reward that is that much greater than buying existing assets. So even if you're developing multi versus just buying existing, sometimes it's great, and when it works, but there's also risk involved there. So it's more complex from a GP angle. From an LP perspective, well, and then this applies for LPs and GPs, but one thing that's very unique about multifamily is the access to debt financing. So office doesn't have this, retail doesn't have this, hotels don't have this, but multifamily has Fannie Mae and Freddie Mac and HUD financing. These are government sponsored enterprises or government agency in HUD's case, and they are in the business of providing liquidity to the housing market, specifically to more affordable housing. They'll pull out all the stops and give you better debt terms. So debt is a very, very critical part of the real estate business. And the biggest risk and the biggest challenges are caused by debt. So if you can get the most attractive debt out there from the government, it really is a cheat code for multifamily, in particular in more difficult times.
Got it. Cool. Okay. That makes perfect sense. And I think that what on the LP side, what people are seeing is that the stock market is so unpredictable. And to us, real estate's, it can be unpredictable for sure, but it is more predictable in my opinion. So you have more control over it. It's tangible. And that's why we felt that people that want to invest $100,000 or $200,000, they can see a solid return and then hopefully keep your money and then exponentially grow it into new deals. So my next question is kind of about your portfolio specifically, and then also your strategy with multifamily. So what does your portfolio look like? I know you have a bunch of properties in Texas. I don't know if they're all there, but that, and then what is your typical strategy when you buy multifamily? Like, do you renovate it over a 1 to 2 year time frame, hold for 5 to 7, and then refi or sell? That's a lot of times what we're seeing, but I'm curious if you have a different outlook.
Yeah, all of our properties are in Texas. So we are very hands-on and focused on our particular markets, so that way we can uncover the best deals, so that way we have boots on the ground with economies of scale, so we can implement our business plans. As far as our strategy, we have a few different ways that we look at deals. What you described was a fairly traditional value add plan, where you buy a deal, you see some upside in it, you do some interior, exterior renovations, maybe improve operations. That would be a traditional value add deal, which we've done plenty of those, and those are definitely a good way to go. For us, I would say renovations typically over 18 to 24 month period of time, at which point we'd look at potentially a refi or a sale, just depending on the debt structure and what the market looks like at that time. I would say we bias towards shorter hold periods versus longer. It's really just comes down to the GP-LP structure and what our investors want. We're here to serve our investors. And investors typically want a shorter hold period, and we're not going to, why would we go against them for that? Especially because when we sell property, if we do a good job, we as the sponsor, we're going to make money with our investors.
Yep, that would be likely the time where you make the most too, right? So you're trying to, you're trying to get to that time frame for everyone's sake. I'm curious about your strategy in 24 going into, it's crazy. We're already halfway through the year almost, another month and a half, right? So your strategy now versus how it has been in 21 to 23, or, even before that, COVID obviously threw a wrench into things, but it's just, besides the fact that margins are tighter because of rates, right? Which is a lot of people know. I'm curious if you're pivoting, what your outlook is and what you see as, what you're looking to do maybe moving forward.
Yeah, more recently there has been and seemingly continues to be a great opportunity in acquiring newer assets. So that's something that we haven't done much of historically because the market was so hot and competitive. And when you look at buying property that is newer and nicer and in a better location, those all obviously drive up the price of the deal, and then you can look at the numbers and they're so thin that your investors aren't going to go for it. It doesn't mean it's a bad deal. It just means that, for example, for us, our investors generally want a return of around 15% or more. Well, if you're buying, let's just to say a dramatic example, like a trophy asset, even if you buy it really cheap, you can't expect a trophy asset to deliver a 15% return. That's just not realistic. A trophy asset is low risk, so it's going to be lower return. It might be 7%, 8%, and that's great.
Would a trophy asset be like like A class? Is that kind of what you're talking about?
Yeah, something that's main location, irreplaceable location, newer deal, great demographics, great growth prospects, supply constraint, all the bells and whistles.
Yeah.
Obviously, those are no secrets, and the market is just going to bid the price of it to reflect a very low return.
Makes sense.
So our investors at this time are seeking higher returns. So that means that we have to be more creative. We have to buy deals that are riskier. That's just the definition. If you want to pursue higher returns, you have to buy riskier deals. So that's what we've been typically doing, is buy a little bit older deals, maybe a little bit worse location. We have to roll up our sleeves. We have to do a little more work. But recently, because of interest rates, and we've had a real estate recession, the market's been shaken up, and there's a lot of volatility, there has been opportunities to buy these really attractive deals at good enough prices that you can actually get the 15% returns, hopefully, while taking lower risk. So that gets me really excited, because if we can get the same return or even potentially a better return while taking less risk, that's a win.
I actually think it's an amazing time for real estate investors. I think what has happened in the past is that anybody can win. That's really the thing. And now a really good strategy and a really good team, they're the ones who are going to win. So I love that. I think that's competition. That's America, which is great. I don't know what your take is on this next question. I'm seeing, and I'm uninformed, so I'd love to know your thoughts if you have any. I'm seeing assets, commercial assets, like St. Louis, for example. I think I'm sure you probably saw it, but like $175 million building selling for $4 million, like 4 years later or something. And then there was another city, I don't know if it was Detroit or somewhere, something similar. And I'm like, that it's also very like, it gets people's attention. It's clickbaity. It's like, is the world falling apart? One, what's your take on it? And two, how do you think that affects multifamily? Because I don't know the answer. I was always wondering if it would trickle over, but every single building I'm seeing right now is turning from commercial to multifamily. So clearly there's still the shortage. How do you think that plays out?
Well, there's a lot that you just mentioned that they play together. I mean, so when it comes to distress in the office space, let's focus in on that. I think that has a minor effect on multifamily by way of hurting investor sentiment. If you see investors that are looking at the market and going, oh, well, real estate's terrible, look at this headline, they may not want to invest in any real estate, even though multifamily has completely different fundamentals to office and is performing much better and is not seeing those price declines. So I think it may have some negative impact on investor sentiment, which, if investor sentiment is impacted enough, that would have an impact on prices. But I don't think that when a St. Louis office building that's vacant and useless and worthless basically gets sold for almost nothing, I don't think that actually has an impact on multifamily values, right? So that's kind of number one. And obviously the reason for that is because they just have substantially different fundamentals. We have a housing shortage. We have too much office, right? People are working from home. People need a place to live, right? It's just very different fundamentals. The other point you made about conversions to multifamily, office to multifamily conversion can make a lot of sense, but it's very difficult to do, and it's very expensive to do. So it's not as straightforward as people think. And not every deal works. Very few office deals actually work. I would say like where we are, actually specifically where I am, downtown Manhattan, there's actually quite a few successful office to multifamily conversions, but that's because the rents here are so high that it's worth the brain damage and the renovation cost to get that office building to multi.
Yeah. Yeah. It's interesting to me that the optics can play so much of a role. And that's the age of the world being flat, right? I mean, things travel, and like having somebody say that, I'm not necessarily I don't want to invest in real estate, that can actually affect it, which I find fascinating. Also, I love how the market is generalized. Like the market is down. Like every single place in this country is so different. Like, and I've learned that because we've invested in New Jersey, we invest in Florida and PA. And I'm finding that, I'm not alone in this, but Florida is a much better place to invest than definitely Jersey in terms of the laws and just like how it's structured for owners versus tenants. So I imagine that plays a big factor in like people want to live in New York City. I highly doubt that there's going to be this big downfall of even commercial there, because that's the hub. You fell in love with New York City. It's like, it's almost simple in a way. Would you agree? Like, I mean, not always that simple, but to me, kind of like, where do people want to go? I know some people are leaving New York City, but like Texas, hence you investing in Texas, Florida, people are going there, invest there, right?
Yeah. I mean, both can be true at the same time. People are, in fact, leaving New York and going to Texas and Florida, but every year there's also a new crop, a new generation of people every year that have the New York dream and want to come to New York. So I would say, I mean, not to make it too much about different markets around the country. I'm not an expert in New York. I just live here.
Yeah.
But
Yeah.
I mean, you're absolutely right. The space market is pretty simple. Real estate markets are underpinned by people, and then you have to look and see, okay, where do people want to live? Why do they want to live there? And then it's not just about people, it's about people who make money. Because if people want to live somewhere, that's fine, but can they afford to pay rent? Do they work in an office? Can they afford to go to the different retailers and spend money? Do they go to the movies or whatever people are doing retail wise? So New York, just as an example, attracts the brightest and the hardest working and people that want to come and make a lot of money and spend a lot of money, right?
Yeah.
And that's why rents are high, is because a lot of people are here willing to pay them. But at the same time, the country has gotten more unaffordable, right? We have an affordable housing crisis. We have a widening income gap and wealth gap, which these are very negative things for the country and very difficult for people to deal with. So what do? There's a flight to cheaper cities, and Texas is a huge beneficiary of that.
Yeah. I think I read something, and I don't want to be quoted on this, but I'm pretty sure I read that 1 in 24 people in New York City are millionaires now. So like, yeah, it's the place. It might not be that exact number, but it's a lot more than
that's definitely right. And then in particular in the city, Manhattan, it's 1 out of 9.
1 out of 9. Wow. Yeah. And so that's the thing. And yeah, being a millionaire is, first of all,
what it used to be.
No, it's a great accomplishment. I don't want to downplay it, but it is definitely not what it used to be. Like especially, on paper, like just inflation is it's eating everything up. So, that's a conversation for another day, but I want to talk about your future goals with your business. Like, what do you see happening with Lone Star Capital in the next, if you had a crystal ball, in the next 3 to 5 years? Where do you want to take it? What's on the horizon for you?
My business partner and I, we are super in tune with each other. We never argue. We just have such an awesome relationship, super respectful. And we just, even if we do disagree, which I think is healthy, it would be a shame if we never disagreed. It's good that we disagree. But when it comes to growth and long-term vision and stuff, we are very aligned. And the way we are aligned is we want to have the best company, not the biggest company. So neither of us are, egomaniacs and want to be billionaires and have like $100 billion portfolio. We prefer the idea of having a great company that is best in class, and that we strive, we're far from perfect, but we want to strive towards perfection in everything that we do. And I think that kind of runs counter to trying to, for growth at all costs. So over the next 3 to 5 years, I really want to keep doing what we're doing, putting one foot in front of the other and just perfecting the craft. I don't want to get pulled in many different directions and start a bunch of new lines of business. it's tempting, once you do grow and kind of get from 0 to 1, the temptation is like, well, maybe this would be cool and maybe we can add this on. But really, the money's made from, first 0 to 1, that's the hardest part, but then 1 to 100, that's the scale.
Yeah. The anybody who's an entrepreneur or budding one or aspiring one has either run into shiny object syndrome or has tried to fend it off at all costs. And I've been fallen victim to it. It's really, really hard not to. It's kind of one of those things like maybe this vertical will work or maybe this will work, and you try it. And there's people that have been doing it for 12 years that are like, no, buddy, like we know how to do this, and that happens. So I love that. Get better at what you're already doing. And then, being a billionaire, it's the time and energy and effort that it would take you to be that. It might not leave you with much left, like in terms of life or being a person. Like, so it's not my goal either. I like to hear that. It's obviously it's shiny and it wouldn't suck, but I appreciate that. So a couple more questions as we wind down. Your books. I'd love to talk about your books. You have 2. Give the audience, what are the books like? Why did you write them? And just share some information about that.
Yeah, the first book was kind of a more organic journey. When I started in the multifamily space, I was consuming all forms of content, blogs, meetups, videos, books, and there was no book or really any comprehensive content on underwriting, which is the financial analysis of an acquisition. And to me, it's a critical part of the business, and being a spreadsheets guy, a numbers guy, that's what I gravitated to most. And I told myself that once I learn more about this topic, I would write a book and give back in a way and be that thing that I wish I had when I started. So that was an organic journey, and it was kind of, it just happened a bit naturally, but it became such a big success, more than I had anticipated. We sold a ton of copies and continue to sell copies every single month, which is just super awesome because it's opened so many doors. It's built so many relationships. We wouldn't be here without that first book. And then because of that success, I thought, okay, well, let me try to capture lightning in a bottle again and write a second book. And the benefit of writing the second book is I have the experience of the first. So from a niche topic of multifamily underwriting, I wrote the second book on structuring and raising debt and equity. And that's a much broader topic. It applies to more forms of real estate than just multifamily. So I knew that if I write a good book on a broader topic, I could sell more copies and we could do even better. And we published that book in October of 2022, and it worked. I mean, it was selling at twice the pace of the first book because we had the benefit of a broader subject and the experience of writing the first book. So we were able to promote it better, market it, and all that stuff, and spend ad money. And so it's like part organic, part wanting to contribute to the thought leadership of the community. And then the other part is a big driver of our marketing funnel and a way that we build a lot of our relationships and trust with investors. So that way, when we pick up the phone with an investor and it's like they've already read the book, they already know who we are, they're already comfortable, they're ready to go.
Yeah, I think that's perfect. It's almost like if you want to learn more about me, read my book, right? And then that creates the credibility that you're looking for to have people network with you that you want to network with, and then potentially invest with you in deals, which I think is great. We're all, everyone's trying at some point to sell that. So, a personal question as we wind down the show. You've done a lot. And how old are you, Rob?
27.
Okay, I didn't know you were that young. So yeah, you've done a lot in a short period of time. Damn, I didn't know you were 27. I thought you were mid-30s. That's a compliment. But
Thank you.
So I'm curious, and I don't think like when I'm only 32, but like I only started to think about this in the last 3 years. Your why and like the whole reason behind this, because you can chase the money, the quote unquote freedom, like you can chase it all, and you can turn around at 47 and be like, damn, like I ran all the way in the wrong direction, and I don't understand how I got here. I'm curious, like what drives you? What gets you up out of bed every morning? Is it really the big life? Is it, and that's not a bad answer either. I'm just curious. We ask a lot of people this question.
Yeah, I think when you ask the why question, it's like money is disqualified. I mean, I would hope that money is disqualified from it, because if you really sit down with someone and they tell you money, you can kind of work through that and get to the real core of it, because it's most likely not money. Like, you'd have to really be like in that egomaniac person who's really shooting for numbers on a
You're
screen.
kind of like psychopathic in a way. It's
Yeah,
only about money, right?
yeah, exactly.
You know?
Right. So I think when you talk about the why, you got to take out the money. But when you take out the money, you're not trying to be altruistic and say, well, I don't need money and money doesn't matter. Money is very important. Money is really valuable for living a good life and providing for your family. So you can't, both can be true. Like, hey, money is important, but we all know that after a certain extent, it doesn't necessarily continue to move the needle when it comes to comfort and happiness and providing. So that's just my take on the money side. Money is great. It's a very
I don't mean to
powerful
cut you
tool.
off, but I'm curious. Do you know any idea where you think that is, that line? I don't know the answer, but I'm good. Like, is there a point where you feel like if I get to this, because you don't want to just be like, oh, I'll get to 10 million or I get to 20 million and then I need to get to 50. Like, it's just like, where are you going? Do you think you know where that might be or no?
Yeah, definitely. I think it's quantifiable. I think it's definitely cost of living adjusted, right? New York is the most expensive city in the country. So, it's funny. I was in the sauna in my building, and the building I live in is across the street from Goldman Sachs headquarters. So a lot of Goldman guys live in the building, and this guy's complaining about making $3 million a year and paying $1.5 million in taxes. And he's like, 1.5 million after taxes. I have 2 kids. I have to, raise a family. Like, it's not enough. It's, where did it all go? So I would say in New York, the bar is definitely a lot higher than many other places. But so, when it comes to middle class, it's kind of it sounds so snobby, but when it comes to New York City, to be upper class and like really have it kind of max out, like you got to make $1 million a year to
Yeah,
provide
I
for
was
a
gonna say that.
family, all that stuff. Like if you make from 1 to 2, it's like, where's that extra money going, right? Like for me, I'm single, so I don't even need $1 million. My lifestyle is, I can't really think of ways to upgrade my lifestyle. I live just such an awesome life. I'm not like, oh, well, if I make more money, I'll be able to fly private. Because would I really though? Because would I feel good about spending $30,000-$40,000 on a flight? Like, I'm not there yet, right?
Right. Yeah.
That doesn't make sense to me. And the difference between flying first and private is a lot better, but is it 10 to 20x the price better? Probably not. So yeah, I mean, it's a fun topic. I like this discussion because it makes money very real. It's like, well, we all want to make more money, but why? Like, what are you really going for? So yeah, I think it's definitely quantifiable, and people should. It's a good exercise to not just kind of aimlessly wander.
I think I cut you off though, and you were gonna get to like the why that you were talking about. I'm curious, like, you can quantify. I think it's good goal. Good to shoot for this goal. Just realize that if you're not happy along the way, I don't think you will be happier when you get to that point, because money only amplifies the person that you are. It doesn't change you, in my opinion. So what's the driving force? Like, what do you want to see?
Yeah, so for me, whether it was growing up playing football or now in business, or working really hard on my GPA in high school and college and stuff, I've always just really liked a challenge and being the best version of myself. So I haven't found what one might call my true calling, and oh, I'm gonna save the world through XYZ. But I'm not pressed to, and I don't feel like a gap. I don't feel like I'm missing something in my life. Basically, what gets me going and fired up is just pushing myself to get the best out of me. So I don't like necessarily to have hobbies, and I don't like to do something casually. My friend wanted to play chess last night, so I said, okay, fine, we play. But I don't want to play chess because I haven't committed my life to being the best chess player possible. So he beat me, and I don't like to lose.
Yeah.
So I would rather apply myself to the things I really care about and just be excellent. That's what drives me the most.
I think that's a really good answer, and candid and transparent. And I think it's worth talking about because it's like I just started playing. The last 2 years I started playing golf, and I sucked. I'm getting better, but I'm noticing the time and energy and effort that it's going to take to get better. It's like, I hate losing, right? I hate being not good at something. And it's the same thing. I just so happen to parlay golf because it does help in business too. So but it's funny, man, because if you spread yourself too thin, what do you really become good at? But then there's the question of like, well, just do things you enjoy. So I don't enjoy chess either. So I would hate losing at it, but I definitely would lose. So cool, man. This has been awesome. I really appreciate your time getting to know you. I want to, if people want to network with you, maybe they want to learn more about you. I know you have an Instagram page. Like, what's the best way for people to get in touch with you, Rob?
Yeah, the best way to learn more and get in touch is on our website. That's lscre.com. On our website, we've got links to the books that we talked about. We've got free downloads of our underwriting model as well as our passive investor guide. So we're always putting out a ton of content. You can, follow me on Instagram or LinkedIn, but on our website is kind of the landing page for everything. And if you want to get in touch, you can do so there as well.
Cool. Rob, this has been great, man. I appreciate your time. It sounds like you're up to big things, and keep it going. And we appreciate your time, and thanks for coming on.
Yeah, thank you very much.
Thanks for tuning in this week to the Weekly Juice Podcast. If you liked what you heard, please leave us a 5-star review on Apple Podcasts, subscribe, and share with friends. The more ratings we get, the more ears we'll get on our show, and in turn, we'll be able to provide you with more high-quality guests. You can also find us on Instagram at Weekly Juice Pod, where we post daily tips and tricks and document our own journey towards financial freedom. Make sure to tune in every Wednesday to get your weekly juice.